Good evening, friends. Once again, welcome to each one of you in this platform, Team CASA, where we are going to learn about the ITR, Income Tax Return, in which in 2 days series, first day totally based on the ITR other than ITR 7, and second day we are going to learn relating to NGO provisions, audit report, and ITR 7. So on behalf of CASA, I would like to welcome each one of you. And first day speaker, CA Charmi Shah ji from Mumbai. Welcome to you, madam, on this channel. And our panelist and one more speaker and expert, Sachin Sinha ji is here. So welcome to you, Sachin bhai.
Thank you, bhai. Thank you.
And definitely we are going to have a wonderful session today and tomorrow also. Whatever you have doubt, you can post in the chat box. I and Sachin ji will try to take up all the queries in between or at the end, whenever it is possible. About Charmi ji, I would like to brief about her as she is speaking first time on this Team CASA platform. My duty to introduce before you. She is qualified BCom graduate from Mumbai University, fellow member of Institute, having certificate course on BR, SR, peer reviewer, and partner at Mayur and Chartered Chartered Accountant, I think based on Mumbai. She is having practice area like tax related matters, social audits, bank statutory audit, internal audit, and other compliances. She is having professionally developed activities. If we talk about, then she is co-opted member in various committee of ICI, WIRC, and other platform of Western region, having co-opted member of social audit, sustainability reporting board, co-opted member of CMIB, CSR committee, and many more such committees. She is very much active in Western region. Also, she has co-authored books on technical guide on accounting of CSR fund by third parties, handbook on certificate of form CSR1, audit of CSR activities, technical guide on accounting expenditure on CSR. So about extracurricular activities, she is having great skill in the field of badminton, table tennis, target rifle shooting, and in yoga. So complete profile is this, and definitely today is going to be a wonderful session. Before starting the first technical session, I request Sachin ji to brief about first day's topic. Over to you, Sachin ji.
Thank you so much, Sumit ji. Thank you so much, Charmi, for accepting our invitation and ready to present your views on the filing of return. So why we plan this session,
Right.
the background is basically we are in the month of July. And what I realized in the last week, that so many queries came to me from my team that what to put in the particular column. There are so many information they are asking either in ITR 2 or ITR 3. And we are not able to answer such question. Reason being that these are all updates. And what I practically feel that most of the chartered accountants who are present here, they are not filing the return particularly. The team members, the article clerk or the office, other members are filing the return and they are only overviewing that everything is going right or wrong. So this is very important to understand as a practicing chartered accountant for all of us, to understand what are the changes that are there, what are the information they are asking for, why they are asking for such information, whether it is required or not required. If not required, then how to put your claim that it is not required for my client. And in case of small clients also, there are 30-40 page return is to be filed. You have to go through all the particulars and then decide what is not required. So first you have to understand what is actually required, and then you have to decide, okay, it is not required, and then you have to fill the information. Presently, everything is online, so you cannot escape any information and move ahead. You have to fill something, either it's yes, no. If number is required, only number is required. If the alphabet is required, only alphabet is required. So because these are challenges in filing of online return. In the manual days, what we used to do, we make a cross by black pen and say not applicable and moving ahead. So now this is not applicable. So these are all challenges, and what I feel that we should all understand how to tackle such type of situation, because we are just 20 days is going for 30th July. So everyone in office, they must be busy for filing these returns. So this is my concern while planning for this, and we thought that Charmi is the best person who can guide us, because technically she is also so qualified, and she is addressing such type of situation in various forums also. So I requested Sumit ji, and thank you Sumit ji for accepting my request. So this is all from my side. I think we not take much time and move ahead to Charmi. Over to Sumit ji. Yes, Sumit ji. So can we start, sir?
Yes, sure.
Okay. Over to Charmi, sir. Charmi,
Yes, Charmi, you can start, please.
First of all, thank you, Sumit sir, for some wonderful introduction and inviting me to your platform. And also Sachin sir, thank you so much for giving me opportunity to take this topic. As we know that there is various notifications and amendments which are relevant for ITR filings have been changed this year. I have bifurcated my presentation between the changes made in ITR form, as well as I have taken amendments which are being changed from this year, which are required for our ITR filing. So many returns have already been filed for this year, as the utility has been planned, and the utility was far back released and notified by the government. So we will directly start with our presentation, so we won't miss our due date or file our return properly. Is my screen visible to all?
Yes, perfect.
Yes, ma'am. Okay.
So let's take about notifications which which have come from ITR 1 to 7 for filing of ITR. So ITR 1 to ITR 6 was notified in notification number 4 2023 dated 10th Feb 2023. What does it say? That they are all eligibility conditions for filing ITR for assessment year 23-24. And this were identical to those for assessment year 22-23 in Rule 12. But let's by ITR wise, let us see what are the notification and what does notification say. That, for example, ITR 1 Sugam, to whom it is applicable to individuals, resident or ordinary resident, having income from salary, one house property, other sources, interest, etc., having total income up to 50 lakh and having agriculture income up to 5,000. But ITR 1 Sugam is not applicable for first, director in a company or has invested in unlisted equity shares, in case where TDS has been deducted under section 194N, or if the income tax is deferred on ESOP. Also, ITR being filed by the virtue of clause 1 of the 7th proviso of 139.1. Proviso of 7th proviso of 139.1 was newly introduced this year. We will look into that into detail in the subsequent files. The next ITR is ITR 2, to whom ITR 2 is applicable for individuals and HUF not carrying out business or profession under any proprietorship. Now comes ITR 3. ITR 3 is for individual and HUF having income from proprietary business or profession. Then comes ITR 4 for individual HUF and firm being a resident, having total income up to 50 lakh and having income from business and profession, which is computed under section 44 AD, ADA or 44 AE. But ITR 4 is not applicable for director in a company or has invested in unlisted equity shares or if income tax is deferred on ESOP. Then comes ITR 5. ITR 5 is same for persons other than individual, HUF, company, and person filing form ITR 7. ITR 6 is under notification 423 says that for companies other than companies claiming exemption under section 11. And ITR 7, which is under notification 5 of 2023 dated 14th Feb 23 says that it is applicable for in a persons including company required to furnish return under section 139 4A, 4B, 4C, 4D, 4E or 4F. Now, seventh proviso to section 139(1). It was introduced in Finance Act 23 with effect, and now it is effect from 1/4/2020. CBDT by notification number 37/2022 dated 21st April 22 in GSR 307E through income tax 9th Amendment Rules 22 notified that conditions for furnishing a return of income in terms of clause 4 of the 7th provision of subsection 1 of section 139 of the Income Tax Act. And for this purpose, a new rule 12AB is inserted in the income tax rules. The CBDT mandates everyone to file the income tax return. If one's income exceeds the basic exemption limit, then they have to file a return of income. But filing an income tax return every year on time has many benefits, even if your annual income is below the minimum taxable limit. So key changes to the Indian tax regulation from time to time would impact the process of income tax filing. So the CBDT accordingly makes changes in income tax return forms and notifies the ITR form to be used every year by each category of taxpayers. So this assessment year 2021, that is financial year 1920, for ITR was changed, and the ITR form contains a section part A general information that asked you to take yes or no for are you filing return of income under the 7th provision of section 139(1), but otherwise not required to furnish a return of income, along with asking you to furnish various information required as per provision. Let us first understand what is 7th provision of section 139(1) all about. So first, it is applicable to all persons except company and firm. Then ITR is mandatory to various person and various conditions. For example, first condition is SSC deposits an amount or aggregate of the amounts exceeding 1 crore in one or more current accounts maintained with the banking company or an cooperative bank. The second condition is assessing incurs expenditure of an amount or aggregate of the amount exceeding 2 lakh rupees for himself or any other person for travel to a foreign country. Or the third condition is if a person has incurred expenditure of an amount or aggregate of amounts exceeding 1 lakh towards consumption of electricity or fulfill such any other conditions as prescribed. Then the conditions come as if his total sales or turnover or gross receipts as the case may be in the business, exceeds 60 lakh during the previous year, or his total gross receipts in the profession exceeds 10 lakh during the previous year, or if the aggregate of the TDS or TCS during the previous year in the case of a person is 25,000 or more, or in case of individual 60 years, for 60 years and above, it is 50,000. And in case he has deposited in his one or more saving account aggregate of 50 lakh or more during the previous year, such persons doing all such activity has to file its ITR mandatory under the provision. Now, let's we have already seen the first condition, that is clause 1 of 7th provision. Now going on to the next point. No option for assessment year 22-23, SSC of the above category was allowed to file ITR 1, 2, 3 or 4. 1 second. Sorry for the inconvenience. Now, for assessment year 23-24, such SSC cannot opt to file ITR 1. This is the only change from this year. If the person is under the 7th provision of 139(1), he cannot file ITR 1. Now comes no option to select SOP. There are types of house property under schedule HP, that is let out, deemed let out, self-occupied.
Sorry, Charmi, can I ask a question here? So,
Yeah.
assuming you are in the falling in the 7th point, so which form is to be filed in that case?
7th point means 7th proviso.
Yes.
Depending on the other income of the SSC, we can go on to any ITR, but ITR 1 cannot be filed. If the category of a person falls under ITR 1, then you can file ITR 2 to prevent any loss. ITR 3 is only for business. They have only said that ITR 1 cannot be filed.
Okay, thank you.
Okay, so going back to no option to select SOP, the first thing, there are 3 types of HP: let out, deemed let out, and self-occupied. Here, section 23(2)(a) says that occupation of the owner for the purpose of his own residence. So there are premises, uses, office, as which is outside the ambit of section 22. So from this year onwards, whichever premises is being used for office cannot be filed under schedule HP. So only schedule HP you can file your self-occupied or let out property. Till now, premises of houses was being used as let out property, and we used to get an interest exemption or interest on loan, etc. But from this year, they have not, the MBA clearly says that the premises which are taken for offices cannot be filed under Schedule HP. The next point comes is no concessional rate of tax for dividend from foreign company. The company itself pays the tax before the dividends are distributed. So DDT applied to both domestic and foreign companies in India. So however, with the Finance Act 2020, DDT has been abolished for Indian companies. Now for shareholders are liable to pay tax on dividend based on their individual income tax. And Section 115 BBD, concessional tax rate of 15% on dividend received by domestic company. Section 115 BBD, a concessional rate of 15% on dividend received by domestic company from an associated foreign company.
Charmi, sorry, I think your screen is not moving. So slides are, we are.
No, I am on the last point, no concessional rate of tax for dividend from a foreign company.
Okay, okay, sorry.
Okay. The point is, after abolishment of DDT, dividend received by domestic company from another domestic company is chargeable at regular rate of tax, that is 25%. So in order to bring parity, Finance Act 22 withdraws the benefit of concessional rate on tax on dividend received by a domestic company from specified foreign companies. Also in this, there is a change in ITR 6, which says that under Schedule OS, that is other sources, reference to tax on dividend received by an Indian company from specified foreign company, 115 BBD has been included. This says that we have to input our dividend on tax or dividend which was exempt. First, we used to put it in exempt income, but now in Schedule OS, the reference has been given to tax on dividend received by the Indian company after this amendment. Now, this is additional disclosure for FPI and FII. Schedule 112A will be disabled if answer to are you an FII or FPI is yes, and Schedule 115 AD will be enabled in ITR 2, 3, and 5. So you can see an additional information about SEBI registration number to be provided by the foreign institution investor or foreign portfolio investor. Whether you are a FIIP, yes. If you say yes, then you have to give your SEBI registration number. And if no, then Schedule 112 will be disabled. Now in ITR 5, there is a change in constitution. If there is a change in constitution in any partnership firm, then additional disclosure is being required. What are the additional disclosure? And they are first, PAN. Second, remuneration paid or payable to the retiring partner in case of a firm, or if there is admission, you have to write information about the new admitted partner in detail. Now comes the next change, that is donation reference number is to be provided if donation is eligible for 50% deduction subject to qualifying limit. So here this box I have taken, which is available in ITR 2, 3, 5, and 6. which says that if you cannot make the ARN number available for all the donations, then you will not be eligible for deductions. So now you have to make sure that the client has ARN number. So now it is the right time that you communicate with your clients and say that whether you have your ARN number with you, because once you start filing your ITR, it will be very difficult for us to go back to them asking for ARN number, and if they will not be having, you would not be able to claim your donations. So this is one of the change which are made in ITR 2, 3, 5, and 6. Many changes have done. Many changes have been done, as there are many changes done in ITR 7 also, which are for charitable trust. So now they are making changes and availability of Form 10BD from the client to match the details which are inserted in Form 10BD. They are asking details from us, like ARN number. Now they want to match this ARN number, the donations, and all the details which are provided by the charitable trust in Form 10BD. So this change have been done to match all the details which are formed by the charitable trust to the charitable society. Now, this is the change which I have already said, that if there is a change in the previous year in the partners or members of the firm, AOP or BOI, if yes, then you have to give the PAN number, date of admission, remuneration paid or payable in case of retiring partner in firm, and percentage of share if determined. So initially this box was not there till last year, but now they have included if there is any change in the partnership or AOP or BOI. Now comes the next change. This is the change which is done in the balance sheet side. Sorry. Additional information is being asked for advances from persons specified in section 48(2)(b) and from others. First, there was only advances and amount has to be completely said, but now there is a bifurcation from persons specified and from others. This would be getting matched with other places in ITR also. So this amount we have to be very much prepared before filing our ITR. In ITR 6 and 7, this bifurcation was already there till last year, but now they have put in other ITRs also to make uniformity. Sunset clause. Sunset clause, first of all, let us check what is sunset clause in Schedule 80IB. SSC deriving profit from eligible industry undertaking can claim deduction under Section 80IB. Now, when industrial undertaking in Jammu Kashmir had time until 31st March 2012 to commence its operation under this section. So as the 10 years for claiming the deduction under Schedule 80IB for such undertaking has expired in 31st March 22, this undertaking are no longer eligible for such deductions in 22-23 financial year. So Schedule 80IB has been amendment to remove the rules allowing for deduction under the above absolute provision. So this rule or this change in ITR was very normal as the 10 years has been passed, and this change have been done in ITR 3, 5, and 6. The next change is change in TCS. This is made in ITR 2, 3, 5, and 6 and 7, mostly all ITRs. This the change in this schedule was mainly because they have connected TCS of current year bifurcated into two: collected in own hands and collected in the hands of spouse or as per section 5A or any other person as per rule 3711. So initially TCS was not claimed for in collected in own hands and financially in which it is collected, but from this year they have bifurcated TCS also as now this is they have made TCS schedule same as TDS schedule. So now all the information which were required in TDS, now they are requiring for TCS also. Now let's look into relief under section 89A. What is taxability under section 89A? Where a non-resident becomes a resident in India, the income in his foreign retirement benefit account is chargeable to tax in India on an accrual basis. So, however, some countries' tax, such as amount at the time of receipt, is chargeable. So there was a mismatch in the year of taxability of such income in retirement funds, and the taxpayers generally, that is the non-residents who have permanently returned to India, face difficulties in availing such foreign tax credit in respect of tax paid outside India on such income. So now section 89A was inserted with effect from assessment year 22-23 and removed the aforesaid difficulty by providing that the income of a specified person from a specified account shall be taxed in such a manner and for such year as may be prescribed in Rule 21 AAA. So for this, they want the non-resident to file Form 10EE and has been filed to select in this form has to be filed to decide by the non-resident in which year they want the taxability. For example, a person staying in Canada now has returned permanently to India and now he is getting his retirement benefit like pension or anything from Canada. So initially, for 10 years, that retirement or pension was being accrued there. And he was paying tax on that accrued pension in India before even getting that income. And at the end, after 10 years, when he used to get the income in his hand, he had to pay tax in that country. So but there are many rules that was not matching in countries like Canada or specified countries like US, UK. So now in India, due to this section 89A, the person can file the form 10E and decide in which year he wants to pay the tax on the retirement benefit that he's getting from another country. So this is also a very welcome change. This is the disclosure which is required for this section. This is gross income chargeable to tax at normal applicable tax. First is E point is any other income. First, family pension. Second, which we were talking about, income from retirement benefit account maintained in a notified country. Now, notified country and specified countries are Canada, USA, UK. Now then, income from retirement benefit account maintained in a country other than notified country under section 89A. Here you have to fill in the amount. And income taxable during the previous year on which relief 89A claimed in any earlier previous year. So they will also want if in any previous year you have taken any benefit from this section or not. Here we have to fill in that amount. Now also you have to specify in information I4 schedule amount the amount of deferred amount. So if in this year you are not claiming tax on a amount rupees 100, then that rupees 100 has to be specified in schedule I4s. Now this is the a connectivity to the earlier schedule. Here after gross income chargeable to tax at normal applicable rate comes amount not deductible under 58, then profit under charge under 59, income under relief of 18. So this ITR form 10EE has to be filed before due date of filing ITR. Now comes taxability of VDA. What is VDA? Is section 247A, which defines virtual digital assets. So any information or code or number or token not being Indian currency or foreign currency generated through cryptography means or otherwise by whatever name called, provides a digital representation of value exchange with or without consideration, with the promise or representation of having inherent value or functions as a store of value or a unit of account, including inherent value or functions or a store or value, including its use in any financial transaction or investment, but not limited to investment scheme, and can be transferred, stored, or traded electronically. So it is basically VDAs are a non-fungible token or any other token of similar nature by whatever name it is called, and any other digital asset as central government may be notified under official gazette specifier. Provided that the central government may by notification in any official gazette exclude any digital asset from the definition of virtual digital asset, subject to such conditions as may be prescribed. So all this VDAs have come under taxability by notification number 74 2022 dated 30th June 22, where it says that VDA would not include any of gift cards or vouchers, mileage point, reward points or royalty cards, subscription to websites or platforms or applications, and notification 75 2022 dated 30th June 22 says that it is not fungible tokens would not include NFT, that is the non-fungible token, whose transfer results in transfer of ownership of underlying tangible asset and the transfer of ownership of such underlying tangible asset is otherwise legally enforceable. This is the schedule which is added in ITR for VDAs. Date of acquisition, date of transfer, which head the income has to be transferred, cost of acquisition, consideration received, and income for transfer of VDA. Here it is said that enter nil in case of loss. So for example, in this example, it is cost is 15 and we have got a profit of 10. So it is coming as 10. But They have said that VDAs where there is loss, they are not considering loss nor carry forwarding any loss from VDA. Here you can see in this schedule, you have written date of acquisition, date of transfer, head under which income is taxed, or whether capital or business, where cost of acquisition is less than the sale price. Here 10 lakh is being shown as income from transfer of VDA. But in case where cost of acquisition is less than is greater than consideration received, where there is loss, they have taken nil. This shows that they are not being they are not accepting loss in VDS. So sum of all positive incomes is only included in this column 7, which are taken under consideration in ITR 2, 3, 5, 6, and 7. So 1 and 4 are excluded from VDA incomes. So now section 115 BBH, which is having a flat tax rate at 30%. So deduction of only cost of acquisition will be allowed here. No other income would be, no other cost would be undertaken for VDAs. Any expenditure, allowance, loss of any other heads cannot be set off against this income. And therefore, the cost of mining and other costs are not considered as cost, which will reduce the profit further. So loss in crypto is neither can be set off against any other income, nor can be carried forward to any subsequent assessment year. The above provision is irrespective of the classification of such income, that is, whether it would be a business income or it is a capital gain. So virtual digital asset is also to be considered as property for the purpose of section 56 to 10, which is accordingly even transferring it or no inadequate consideration will be subject to applicable provision. Now coming to disclosure for intraday trading. What is intraday trading? We will consider for intraday trading section 43(5), that is speculation transaction, means a transaction in which contract for purchase or sales of any commodity, including stock and shares, is periodically or ultimately settled otherwise than by an actual delivery or transfer of the commodity or scrip. So provided for the purpose of this clause, an eligible transaction in respect of trading in derivatives referred to as clause AC from the section 2 of Securities Contract Act 1956 carried out in a recognized stock exchange or shall not be deemed as a speculation transaction. And moreover, ICI guidance note on tax audit, which has said and defined the turnover of this transaction. What it defines as a speculative transaction means a transaction in which a contract for the purpose or sale of any commodity, including stock or shares, periodically, and it is settled otherwise than an actual delivery or transfer of commodity or scrip. So thus, in a speculation transaction, the contract for sale or purchase which is entered into is not completed by giving or receiving delivery so as to result in sale in the sale as per value of contract note. So the contract is settled otherwise and squared up by paying out difference, which may be positive or negative. As such, in such transaction, the difference amount is the turnover. So in case of an SSE undertaking speculative transaction, there can be both positive or negative differences arising by settlement of various such contracts during the year. So each transaction resulting into various positive or negative differences is an independent transaction. So further, the amount paid on account of negative difference paid is not related to amount received on account of positive differences. So finally, let's see what the ICI guidance note says. It says that in such transaction through the contract notes are issued for full value of the purchase or sold asset, the entries in the books of accounts are made only for the differences. Accordingly, the aggregate for both positive and negative differences is to be considered as the turnover of such transaction for determining the liability of audit via section 44 AP. Now the intraday transaction here, it has to be shown cost of goods purchased, transfer from manufacturing, gross profit from BP, turnover from intraday trading, and income from intraday transferred from PL. So it is a part of P&L in the it comes amount from gross profit. This is a below line item, and here the changes are being seen in ITR 3 and 5. This section 115 BAC, where you can undertake in ITR 3 and 4, opt in and opt out. So basically, ITR 115 BAC is an alternative taxation scheme applicable for individuals and HUF or person carrying on business and profession. So option 1's exercise, the option of section 115 BAC, one's exercise is allowed to withdraw only once, that too for a previous year other than the year in which it was exercised. So once such option has been withdrawn, the SSE can never be eligible to exercise option under this section, except where such person ceases to have any income from business or profession. Now here, disclosure of opt-in and opt-out has been asked. Here, have you ever opted for the new tax regime 115 BAC? Yes or no? If yes, what is the first in said option was exercised, in which year you have started? If yes, date of filing of form 10IE also asked, acknowledgement number. If you have opted out of section 115 AB, which is highlighted in red, yes or no, you have to write. And if you say yes, then the another highlighted red box, that is option for the current assessment year, select opting. And now if you are opting in the first year. So in this manner, they have been asking each and every part of when you have opted in, when you have opted out, is this the first time you have opted, etc. in ITR 3 and 4. Here there is instructions of 300 to 500 pages which have been given by the CBDT, which says that option for the new tax regime under section 115 BAC will be available only till the due date of filing of return under section 139(1). That is, we have to file form 10I for going into this regime. So the taxpayer can opt in or withdraw from new tax regime under section 115 BAC in revised return if it is filed within due date as per section 139(1). So what about PCIT versus Wipro Limited in 22, which is a Supreme Court judgment? So it says that revised return of income under section 139(5) cannot be filed to withdraw claim and subsequently claiming carry forward or set off of any loss. So it cannot switch from old regime to new regime in the revised return. So if you are going for revised return, you cannot shift your tax regime. So initially, if you are going for old regime, you have to carry forward your old regime. If you are started with new regime, then you cannot switch back to old regime in the revised return. But if the department, but something in the public domain, then it precedes, then Supreme Court judgment will be the final. Now, this is the changes which were done in ITR 1 to 6. Changing in ITR 7, I'm not touching upon, as it is being to be carried by the next speaker tomorrow. So let's go to relevant amendments which are very much important for filing of return this year. So which are the amendments? They are section 80 CCH. So taking one by one, what is section CCH? It is being eligibility is individual who has enrolled for Agnipath scheme and subscribing to Agnivir Corpus Fund on or after 1/11/22. In Agni scheme, who are the contributors? Eligible individuals and the central government. So both were the contributor for this scheme, where contribution to the CG, that is the salary under section 1719, amount of deduction under section 80 CCH. So here they have said that now individual opted for regular scheme would get deduction of both the amount which is contributed by the individual itself, as well as central government contribution would be allowed for deduction. But if the individual has opted for new scheme, that is section 115 BAC, then contribution which is made by central government is only eligible for deduction. Now going on to the next section, section 68. Section 68 is, as it is not important for return filing, but the nature and source of any sum, whether in form of loan or borrowing or any other liability credited in books of accounts, SSE, shall be treated as explained only if the source of fund is also explained. So here first, initially, any of the amount which was where we only written loans and liability in our return of income would suffice. But now they have said that now if the person who has given you the loan or you have taken, both the person should have returned the liability and the source. So there is only one exception which says that this additional onus of proof would not apply if the creditor is a well-regulated entity. That is, it is a venture capital fund, venture capital company registered under SEBI. And this action is applicable with respect to 1/4/23, that is assessment year 23/24. Going on to the next section, section dividend and bonus striping. Dividend striping is a practice where the investors buy shares of a company or mutual fund units on knowing about dividend declaration, earns tax-free dividend on such shares or units, and sells them later to adjust short-term capital gain against other capital gain income. So, subsection 7 of section 94 deals with provision prohibiting dividend striping in case of shares or units, and subsection 8 of section 94 deals with provision prohibiting bonus striping in units. The word in units is very important. And bonus striping, prohibitory, anti-avoidance provision are made applicable even to shares and stores. So the loss incurred in selling such units will not be allowed in our ITR, which is applicable with respect to from 1/4/23, that is assessment year 23/24. Going on to next section, that is 43B. Section 43B, which says that interest payable on any loan or borrowing borrowed from PFI, state for financial corporation, state industrial undertaking, NBFC, systematically important NBFC, scheduled bank, cooperative bank. If you have made actually paid such interest, then only you will get deduction to the above interest paid. So claiming deduction under section 43B of the Act on account of conversion of interest payable on existing loans into debentures as it amounts to actual payment, being constructive discharge of interest liability upheld by various courts and tribunals. In this way, liability is deemed to be paid. So explanation of 3C, 3CA and 3D to the section 43B of the Act were amended to provide that conversion of interest payable under clause D, clause DA and clause E of section 43B into debentures or any other instrument by which liability to pay is deferred to the future date shall also not be deemed to be actually paid. So still the amount stands to be paid in the assessment year. Now comes the last third section, tax relief for parents and guardians of the person with disability. As we know that deduction of rupees 75,000 or 1,50,000 for the SSC having dependable persons with disability for maintenance was to be given. The deduction to resident individuals under section 80 DD2 was allowed only with regards to any amount paid under the scheme issued by LIC or any other insurer, where the scheme provides for payment of annuity of lump sum only in case of death of the subscriber, that is parent or guardian, to the dependent. So, however, in some cases, the person with disability may need payment of annuity or lump sum during the lifetime of a parent and guardian also. So Finance Act 22 here says that hence in order to remove such genuine hardship, amendment in section 80 DD2 was made so as to allow even schemes providing for payment of annuity or lump sum amount upon attainment of age 60 years or more of an individual or a person of HUF in whose name subscription to the scheme has been made and where payment or deposit has been discontinued. So further, the amount so received by the dependent disabled person during the lifetime of the insurer shall not be taxable in the hands of such dependent disabled person. Section 79A, it is like set off against undisclosed income. After section 115BB, the Income Tax Act, the following section shall be inserted with effect from first day of April 2013. It says that 115BBE, tax on income referred to in section 68, 69, 69A or 69B or 69C or section 69D, where the total income of an SSE includes any income referred in section 68, 69, section 69A, C or D, the income tax payable shall be aggregate of the amount of income tax calculated on income referred in section 68, 69, 69A, B, C, D at the rate of 30%. And the amount of income tax with which the SSE would have been chargeable had his total income been reduced by amount of income referred in clause A. So this new section 79A is by the Finance Act 2022, and it provides that where consequent to such proceedings under 132 or 132A or survey proceedings under this act, if total income of the taxpayer includes any undisclosed income, then no set-off or any loss, including unobserved depreciation, shall be allowed against such undisclosed income. The last section is section 14A. Section 14A cannot be evoked where no exempt income was earned by the SSA. The case study CIT versus Chedinath Logistic Private Limited, 2018, 257 taxmen to Supreme Court judgment, and PCIT versus GVK Project and Technical Services Limited, 2019, 106taxmen.com, 181 Supreme Court judgment. And what does this amendment says? That for the removal of doubt, it is hereby clarified that notwithstanding anything to the contrary contained in the Act, the provision of this section shall apply and shall be deemed to have always applied in a case where the income not forming part of total income under this Act has not accrued or arise or has not been received during the previous year relevant to the assessment year, and the expenditure has been incurred during the said previous year in relation to such income not forming part of the total income. Now, taxability of interest on provident fund. Now let's look at its background first. Section 10, 11 and 10, 12 provides that interest credited every year in specified provident fund account is exempt from tax. So, however, pursuant to amendment made via Finance Act 21, if provident fund pays interest above the specified limit, such excess interest is charged to tax. So, manner of deriving taxable component of interest as per Rule 9D. So, it provides that separate account within the Provident Fund account shall be maintained during the previous year 21-22 on and onwards for the taxable and non-taxable contribution made by the person. So, if there is a contribution from employer in a specific PF, then taxable interest would be the interest income accruing in respect of the SSC's contribution above over 2,50,000 during the assessment year. And if there is no contribution from the employer in the specified PF, that is PPF, then the taxable interest under IFOS would be the interest income accruing in respect of the SSC contribution over 5 lakh rupees during the assessment year. Now, here it is showing computation of non-taxable and taxable contribution. Non-taxable contribution account balance as on 31st/3/21 plus contribution upon up to threshold limit every year from 21-22. Then add interest accrued upon, then withdrawal from the following: interest on the above balance and exempt under 10, 11 and 10, 12. In the same fashion, it is taxable contribution account. Here in our schedule, interest accrued on contributors to PF to the extent taxable for first provision of section 1011. Here bifurcation is given for interest accrued on contribution for second provision, first provision to 1012 and second provision to section 1012. Now going on to taxation of ULIPs. Now, first let us check what is taxation of ULIPs. ULIPs comes under section 1010D. Section 1010D provides for exemption on any sum received under LIP, that is life insurance policy, plus bonus on it. So no exemption in respect of this policy would be given where premium is more than 10% of the sum assured. So there is deniable of exemption under 1010D for ULIPs where policy is issued on or after 1st Feb of 21. If annual premium is more than 2,50,000, if any year during the term of the policy, if multiple policy have premium more than 2,50,000, that is exemption allowable for those policy of which aggregate annual premium is up to 2,50,000, and this amount is taxed under capital gain under section 45(1)(b). Now there are various schedules in our ITR which are of much importance, and what are the changes in it we would Now look into it. First is Schedule FA, fixed asset, where table A1 there is foreign depository account, table A2 foreign custodian account, A3 foreign equity and debt interest, A4 foreign cash value insurance contract or annuity contract, financial interest in any entity outside India, table C any movable property outside India, table D any other capital asset outside India, and table E any other account located outside India in which you are a signatory authority which is not reported in table A1 to D. Then comes table F, where trust is created outside India in which you are a trustee, a beneficiary or a settler, or any other income derived. It is coming in table G. Then who is required to report? If you are resident in India, you are required to furnish details of any foreign assets. Resident means a beneficiary owner or beneficiary or legal owner. This schedule need not be filled up if you are and not ordinary resident or a non-resident. So details are required to be reported even if the specified asset is held even for a single day. So if you have held foreign asset during the previous year, which have been duly reported in the schedule of FA, then even then you are required to report such foreign asset again in schedule AL if applicable. So rate of conversion, TTBR of a foreign currency, that is exchange rate adopted by SBI. Here you have to write everything. Next comes the schedule reporting. Period of reporting was a confusion here. So definition of relevant accounting period was given under the instruction of ITR. Relevant accounting period has been changed to calendar year ending as on 31st December 22. So as for financial year 23-24, 1/1/22 to 31st December 22, and from 1/1/23 to 31st 3/23. Now come details of directorship, which are in ITR 2 and 3. For initially, details were not asked in ITR 2 and 3. Now you have to give details of directorship in ITR 2 as well as ITR 3. Whether you were a director in a company at any time during the previous year, yes, no. Name of the company, PAN of the company, DIN number, type of company, whether it is shares or listed or unlisted. Then furnishing of PAN and DIN is not mandatory in the case of foreign companies, but however, PAN should be mentioned if such foreign companies have been allotted a PAN. So this is the relevant schedule. So non-resident taxpayer who is a director only in foreign company which does not have any income received in India or accruing or arising in India should answer the relevant question in negative. So whereupon he would not be required to disclose details of such foreign companies. So a non-resident taxpayer who is a director in domestic company and in foreign company which does not have any income received in India or accruing or arising in India should answer the relevant question in affirmation and provide details of directorship in the domestic company only. So a resident taxpayer is required to disclose details of directorship in any company, including foreign company, in relevant column. Now, details of unlisted shares which are being asked in every ITR except ITR 1. Whether you have any unlisted equity shares at any time during the previous year. If yes, please furnish the following information in respect of equity shares, yes or no. What are the details asked? Name of the company, type of the company, whether it is domestic or foreign, pen of the company, opening balance, number of shares and cost of acquisition. Shares acquired during the previous year, number of shares, face value, issue price and purchase price. Shares transferred during the year, number of shares and sales consideration. In this manner, they have asked in much detail. Investment in unincorporate entities, that is in ITR 6. But before that, in this unlisted shares, if you have held shares of a company during previous year which are listed in the recognized stock exchange outside India, you may select no here and you are not required to report the requisite details here. So in case PAN of a delisted company cannot be obtained, you may enter a default value in the place of PAN as N, any 000 and N. So in case of unlisted equity shares, shares are acquired or transferred by the way of gift, will, amalgamation, merger, demerger, or bonus issued, etc. And in such cases, you may enter 0 or the appropriate value of cost of acquisition or sale consideration in such cases. So please note that the details of unlisted equity shares held during the year are required only for the purpose of reporting. So the quantitative details entered in this column are not relevant for the purpose of computation of total income or tax liability. So even if in case where you have held unlisted equity shares as stock in trade or business during the previous year, you are required to report the same in this clause. So in case you are holding equity shares or a cooperative bank or credit societies which are unlisted, only the details of equity shareholdings in any entity which is registered under the Companies Act and is not listed on any recognized stock exchange is only required to be reported. So investment in unincorporated entity of ITR 6. Here in Schedule 1 IF, information regarding investment in unincorporated entities have to be given. That is name of the entity, type of entity, PAN, whether entity is liable for audit, yes or no, under which section 92 is applicable, percentage share, amount of share in profit, capital balance, etc. Now comes details in Schedule 112A, which is applicable in ITR 2, 3, 4, 5, 6, and 7. CBDT has press release dated 26 September 2020, and there is no requirement in the return of income for script-wise reporting in each short-term business income arising from share transaction. So the script-wise details in the return of income for financial assessment year 2021 was required to be filled up only for the reporting of long-term capital gain, but for these shares units which are eligible for benefit of grandfathering. So thus, the main intent behind requiring script-wise detail is to facilitate the taxpayer incorrectly computing the long-term capital gain on the shares and units. But now script-wise is not compulsory. Now comes Schedule AL, which is in ITR 2, 3, and 6. For ITR 2 and 3, for ITR 2, applicable in case of total income exceeds 50 lakh, and in ITR 3, other than those includes in Part A of the balance sheet. So now applicable in the case where total income exceeds 50 lakh, assets and liability at the end of year, if you are a non-resident or resident but not ordinary resident, only the details of asset located in India are to be maintained. So if you are held foreign assets during the previous year, which have been duly reported in Schedule FA, even then you are required to report such foreign asset again in Schedule A. So for the purpose of this schedule, the amount in respect of asset to be reported will be the cost price of such asset to the SSE, or whether where wealth tax return was filed, a value of such asset as per latest wealth tax return, or cost of improvement incurred. And in the case of asset becomes the property of the SSE under the gift, will, or any word specified in section 49(1). So the cost to the previous year plus cost of improvement by the SSE previous owner, in case where the cost at which the asset was acquired by the previous owner is not ascertainable and no wealth tax return was filed in respect of such asset, the value may be estimated at the circle rate or a Boolean rate, as the case may be, on the date of acquisition by the SSE, as increased by the cost of improvement, if any, or 31st March 21. So in ITR 6, AL1 is introduced, where you have to give details of asset and liability at the end of the year only for unlisted company. And the schedule is not required to be filled up by foreign unlisted company. If you are a startup, whether you have filled declaration in Form 2 with the DPIIT, aforesaid details should be filled up in Schedule AL2 and not in this schedule. So details of asset held as stock in trade or business are also required to be reported, and only the aggregate value are required to be filled up, and the particular details of each asset held in stock in trade is not required to be reported here. So the purpose for which it is used in stock in trade in case of unlisted company holds foreign assets during the previous year, which has been duly reported in the schedule FA, the same is required to be reported here also. Now, if the head of income is dividend, first we has used to write in income from other sources, that is section 56(2)(1). So dividend for shares and securities held as stock in trade, there are 3 case studies like CIT versus Peer Stock Holding Private Limited, or CIT versus Excellent Commercial Enterprises, and Sangam Investment Limited versus CIT, which says that dividend can be shown as income from business also. So now going into depth, you have to check whether this dividend is your business income or income from other sources, and then decide upon where to write. So now they have also introduced this schedule where in schedule BP, they have asked for income receipts credited to P&L considered under other heads of income, which is chargeable under 115 BBF or chargeable under the 115 BBG, where the income it comes to dividend income. So because of this amendment, they have also inserted this thing in ITR where the dividend income which falls under business income has to be shown in schedule BP. Then dividend income which falls under 115 AC and 115 A1 has to be divided under the time period within which it is received, that is up to June or December or March. So this bifurcation has also to be shown. Then deduction against dividend income under section 57, only for interest expense you can claim deduction. Maximum 20% of the dividend income can be claimed as expenses. No provision to carry forward the interest expense in excess to 20% has been shown, and brought forward business loss set off against dividend income IFOS. So if you are liable to maintain accounts under section 44AA, yes or no, there is a drop down to say yes or no. In case you are engaged in any specified business, that is medical engineering, architect, technician, consultancy, and your income from business or non-specified profession exceeds 2.5, or the turnover of such business or non-specified profession exceeds 25 lakh, then you are liable to keep and maintain books of accounts and other documents. So in case you click yes is selected for this, then any income which is being reported in form 3CD as not routed through P&L is expected to be routed through schedule OI or schedule BP. Now applicability of audit under section 44 ABE. Where subsection 5 of schedule 44 AD was substituted with Finance Act 2016 with effect from assessment year 17-18, which says that notwithstanding anything contained in the foregone provision of this section, an eligible SSE who claimed that his profit and gain from the eligible business and lower than the business profit and gain specified in subsection, and those total income exceeds the maximum amount which is not chargeable to income tax, shall be required to keep and maintain such books of accounts and other document as required under subsection 2 of section 44A, and get them audited and furnish a report under the audit which is required under section 44AP. So here the erstwhile provision for the audit was plain and clear, and the requirement for maintaining books of accounts and getting them audited arose only when both of this condition was fulfilled. Which condition? First condition is the SSE claims that his profit rate is lower than the rate of profit, that is 8% or 6%. And such SSE total income exceeded minimum amount not chargeable to tax, that is the basic exemption limit. So thus for any given year, SSE declared profit at the lower rate than specified was required to maintain books of accounts and get them audited in that particular assessment year only. So presently similar provision exists in subsection 4 of section 144 ADA, where if the profit are declared at the rate lower than 50%, which is the prescribed, then tax audit record is attracted. Going on to section 44 AD4 provides that if for any assessment year the assessee has obtained for provisions of section 44 AD, and if any time is immediate succeeding 5 assessment year, such assessee declares profit not in accordance with the provision of section 44 AD, then in such circumstances, the said assessee will be ineligible to opt for benefit for presumptive taxation of the section 44 AD for 5 assessment immediately succeeding the year in which the assessee decides not to declare profit in accordance with section 44 AD. Here I have taken a small example stating this section that Mr. RST claims to be taxed on presumptive basis under section 44 AD for assessment year 1920. For assessment year 2021 to 22-23 also he offers income on basis of presumptive taxation scheme. So however, assessment year 3 for 23-24, he did not opt for presumptive taxation scheme. In this case, he will not be eligible to claim benefit of presumptive taxation scheme for next 5 assessment years, that is 24-25 till 28-29. So present section 44 AD5, which says that notwithstanding anything contained in the foregone provision of this section, an eligible assessee to whom provision of subsection 4 are applicable and whose to income exceed the maximum amount which is not chargeable to income tax shall be required to keep and maintain such books of accounts and other documents as required under subsection 2 of section 44A and get them audited and furnished a report as required by 44AB. So as per the existing provision of 4485, once the provision of 4484 are applicable, maintain of books and getting them audited applies. However, the moot issue is when the ineligible provision of 4484 are attracted is applicable for subsequent 5 assessment year. So by strict interpretation of section 44 AD4 and AD5, read with section 44 ABE, it can be said that on provisions of section 44 AD4 is applicable, the SSC will be liable to maintain books of accounts, get them audited and furnish the report for total 6 assessment year. And that is the assessment year in which section 44 AD is not opted and then the subsequent 5 assessment year. So if a person adopts the presumptive taxation scheme, but he opts out from the scheme in any of the subsequent 5 years, then what are the consequences? If a person opts for presumptive taxation scheme, then he is required to follow the same scheme for 5 years. If he fails to do the same, the presumptive taxation scheme will not be available for him for the next 5 years. So if he is required to keep and maintain books of accounts and he is liable to tax audit under section 44AB, from the assessment year in which he opts out from the presumptive taxation scheme, the use of word from instead of for in the answer is above FAQ clearly suggests that the requirement is maintaining books of accounts and audit applies for total all assessment year. Now comes, can there be a scenario where SSC declares profit lower than the prescribed profit rate, but still is not liable to do audit? Yes, there are scenarios. The first scenario is, it is the first year of business and the turnover is up to 1 crore. And SSC maintains proper books of account and declare lower profit than 8%. In this scenario, the provision of subsection 4 is not attracted, and because it is a first year and there is no preceding year in which 44AD might be opted so as to opt out in the relevant assessment year. Here comes scenario 2, where the business of the SSC is continuing since several years. However, each of this preceding year, the SSC has either gotten accounts audited or has maintained proper books of accounts, but not subject to audit. So in this scenario also, if the SSC declares profit at the lower rate, he still won't be attracted by the provisions of subsection 4 because he has never opted for section 44AD and he has opted out of it. So accordingly, even if the lower profit is declared, audit as per clause E under subsection 44AB, read with subsection 5 of section 44AD, will not be applicable or attracted. So pertinent to mention that compliance of maintaining books of accounts as per provision of section 44A needs to be kept in mind with this scenario. Now, what is e-campaign? The objective of e-campaign are to collect taxpayers' feedback, explanation on selected information and queries. So to promote voluntarily compliance and deter non-compliance, Income Tax Department enables a taxpayer to go under the e-campaign. What is e-campaign? It is a portal of selected under the e-campaign. View and provide responses on queries asked by the e-campaign. So following are the categories where the response is expected from taxpayer under e-campaign. First is the preliminary response and second is feedback on information on AIS. First is the functionality enables the taxpayer to provide feedback on information which is marked as expected under e-campaign and when no feedback has been provided. Here is the schedule and the taxpayer is required to provide feedback on the information which is marked as expected. So you have to mark them feedback expected and give the answer what they want and how they want. Then comes feedback processing. Information is correct. If the information is marked as correct, then the reported value in AIS is taken as correct. feedback type where information is not fully right, where you can give your feedback where update information detail like security, name, asset, quantity, cost of acquisition. Here you can change whatever feedback you want to give in AIS. Then if there is a duplicate information included in other information, then if the information is marked duplicate or stated to included in other information, the modified amount has to be taken in AIS and will be taken as 0. So if the information is marked as not fully correct, then the modified attributes and values are saved in AIS. So the derived value, the value derived after considering the taxpayer feedback in taxpayer information summary will also be reduced to enable seamless pre-filling. So the feedback will be processed in accordance with the risk management system. And in case where modification is substantial, information source may be contacted to confirm that the modification or provide additional information. So in case of duplicate information, the derived value, that is value derived after considering the taxpayer feedback in taxpayer information summary will also be reduced to enable seamless pre-filling. So the feedback will be processed in accordance with the risk management system, and in case any information is duplicate, information source will be contacted. Here there is information relates to other PAN, that is here information relates to PAN here. This information has to be added. If the information is derived, the modified value in AIS will be 0 and the feedback will be processed in accordance with the risk management. FAQs on AIS. First FAQs where question number 13, is there any limit on number of times you can modify your feedback? Currently, there is no limit on the number of time you can modify your feedbacks. Then comes can a response be submitted, be modified? For modification, user needs to select reasons and provide remarks if required. And below are the reasons for modification. Earlier response provided by mistake, incorrect details entered, response no longer valid or others. And if the user selects others as the reason, the remark text box comes to mandatory. So modification can be done multiple times and each submission done by taxpayer separately. Acknowledgement receipt and PDF will be generated by system, which can be viewed through activity history. Departmental FAQs on issues of ITR filing. That comes to differences between income as shown in AIS and 26 AS. So income reflected in AIS and 24 AS are based on information received from different sources and tax compliances made by different stakeholders. So these are made available to the taxpayer for reference purpose, and taxpayers should make by different stakeholders. These are made available to the taxpayers for reference purpose, and the taxpayer should check his books of accounts, records, provide information, and return as per information available with it. Notices to the SSE under section 133(6), which seeks various information like first, CA or the taxpayer who has filed the ITR. Second, whether proof of donation were provided to them. And third, who has signed the ITR. So this information they have to give to in their notices. With this, I end my presentation.
Thank you so much, Charmi.
Thank you,
Excellent,
sir.
excellent presentation, and you have covered, I think, exhaustively almost more or less everything. There are
Yes,
few
sir. I was
queries.
satisfied.
There are few queries in the chat box. I think you have covered in such a manner so that people are not able to raise much queries, because either here or there their queries has been satisfied. So first question we have received from Rohit Jasuja ji, that virtual digital asset taxable may be repeated if possible. So they want to understand the taxability of virtual digital asset.
That I think it's a long process. It will again take half an
Yes,
hour.
yes, I agree, because the time will not permit to reiterate everything again. But I request Sir Rohit sir to please refer 115 BBH, and I think your query will be resolved there. So kindly explain about section 14 with example.
14A.
14A.
14A we have already seen in my presentation also, as they have said that any expenditure which was first allowed as this first we had 14A assessment year. So I can say that now disallowance under 14A has been considered and cannot be evoked. As first, if we do not have any exempt income, then 14A would not come. So, but if we have exempt income like dividend income or any income under section 11, then only this section would provoke itself. And now, but for this removal of doubt, it is here clarified that the provision of this section shall apply and shall be deemed to be applied only in cases where the income which does not form a part of total income, means only the exempt income part has not accrued or arise and not has been received during the previous year. So right now I do not I'm not getting a click of any example, so I can only explain section.
So I can give one example. I can give one example. So assuming there is some agriculture income you have, or dividend income, let's say, or agriculture income is the best example. Assuming you have agriculture income during the year and you have incurred some expenditure for this. Since the agriculture income is exempt itself, so any expenditure incurred in this regard would not be allowed.
Yes, sir.
Okay. So the next question is, schedule of FA is mandatory or attachment will serve the purpose?
No, it is mandatory right now from this year.
Okay. So I don't know how the attachment can be done, but yes, since you said that attachment, it is mandatory. Kindly explain bonus stripping taxation.
Bonus stripping taxation means first of all, if we are in the information that the said company is going to give any bonus, and we before the record date the person buys the shares. So the taxation on such bonus share is called the bonus stripping taxation.
Okay. Mr. Rajiv has mentioned that I am interested in Form 10B and ITR 7. So, sir, I think your query will be answered tomorrow. Yes, yes, thank you, sir. So, Tuesday we will already answered. Sanjeev Mahajan sir has that investment is made in the name of both wife and husband. Same amount of interest on this investment is showing in the AIS of both the SSC. how to deal with this issue. If feedback has to be made from duplicate as 0 in husband's ITR and show the amount of interest in wife name having the first name of in investment, does it work?
Yes, it works. Because of this issues only, they have taken AI as feedback. So this can be possible after this amendment, which are made in AI as feedback.
Okay. One more question from Mukul sir, that how to show gain arising from sale of agriculture land in rural areas.
In ITR. So sale of agricultural land can be shown in capital gain or in exempt income, wherever, whatever you show as. But in agriculture land, I will get back to on these issues. I'm not sure of which schedule you have to write this.
Yes, correct. Because
I think it should be
unfortunately,
exempt income schedule, it should be there.
so unfortunately, this is neither a capital
Yes,
gain,
right.
because it's not a capital
Or
asset,
exempt income.
nor an exempt income, because it is not an income per
Not a
se.
capital asset at all.
Not an
Okay.
income per se for the
Okay.
purpose of income tax. So what I can suggest, because we have just did this practically, we have mentioned in the footnote that there is an agriculture sale of agriculture land of this much of rupees, so that subsequently if department comes to us that this much of amount is showing in your bank account as a credit amount, we can refer that we have already mentioned in the ITR. For the purpose,
ITR footnote at which place, sir? कहाँ पे लिख सकते हैं?
so there is a space already given in the to mention that in the footnote.
Okay.
How many days it takes for correction of AIS?
It all depends on department. They are saying that it will take 2 or 3 days officially, but we cannot confirm on department side.
Okay, so I have 3-4 minutes we have, so let me take the opportunity to encash this. I have one question from my side. While referring ITR 3, in line item number 47, they said bad debts. Bad debts. Now they are also saying specify PAN or Aadhaar of the person if available, for whom the bad debt amount of rupees 1 lakh or more claimed as amount. So assuming I am writing off any amount as a bad debt, then I have to mention the PAN number of the person whose amount I am writing off.
Yes.
I don't know what is the purpose. Department may reconcile this with the
department is using this. In one of our case, we have faced.
So department may
department is using this PAN number to ask कि you have not shown any other income while
yes.
XYZ has shown
sometimes
bad
it
debts.
practically it happens that we write off the amount for the purpose of our books, but we did not give the credit note to the party or the debit note to the party, so that they can also write off it in or shown it as income. Because we also believe at the same time that I am writing off because it is since long it is showing in my books, but at that at the same time I don't want the party to know that I am writing off it in my books.
Definitely,
So
we have a hope that we can recover this amount later on.
So I think there is all the questions we have taken, and so thank you so much. It was an excellent presentation, and I request if you can share your presentation PPT with the CASA, so that every member can get benefited from this.
Yes, sir. Sure,
Now
sir.
handing over to Asha for the formal vote of thanks.
Thank you so much, sir. And thanks a lot, Charmi ma'am, for such a wonderful and detailed presentation. सिर्फ ITR के particulars को नहीं रखा आपने. You have touched other points also, like audit का भी आपने उसमें touch upon किया, 44, AD4 and AD5. So thanks for a wonderful presentation and all the participants who have joined us today. And कल ITR 7 पर है, so we will request to join us again on tomorrow. Thanks a lot, each and everyone. Thank you so much.
Thank you, Asha.
Thank you, sir. Thank you.
Thank you. Thank you, Sukhdev.